This is not financial advice. I'm recording my thoughts about Affirm Holdings, which is a buy now, pay later company. Previously, I have done two videos on Affirm when the price was at about $50 and $18. And in both cases, I said I'm not going to buy this stock because of the risks. Today, Affirm announced their Q4 2022, like the fiscal year results, and they met the revenue as well as earnings per share estimate targets. But the stock is still down about 14%. It's currently trading at about $27. When a company meets earnings per share estimates and revenue targets and still dropping, that means that their forward guidance is not good. The analysts were expecting much higher guidance, but Affirm gave much lower guidance than expected. For reference, for fiscal year 2022, they grew their revenue at about 55% from $850 million in fiscal year 2021 to $1.3 billion in fiscal year 2022. For financial year of 2023, Affirm only guided to $1.6 to $1.7 billion of revenue, whereas the analysts were expecting about $1.9 billion of revenue. That is a significant deceleration in revenue growth, right? So that's why the stock dropped. Currently, the stock is trading at about $27, and I need to make an investment decision to buy this stock or not. The risks still remain, but when I do an evaluation, I would assume revenue growth rate and net profit margin and the multiple based off of those two numbers. But for me to do an evaluation, I need to have a good grasp of this revenue growth number. When we look into their past few quarters and the past year, it's very different, right? One time they grow at about 70%, then 50%, then 30%. So we do not know how the growth would be in the coming year. So estimation of this growth is very, very different, especially when the management doesn't give long-term projections. So it is not a good idea to do an evaluation, but for my reference, I just want to do an evaluation with some reasonable numbers which are conservative to see where the risk reward is. So here is my evaluation for 2026. In financial year of 2022, we do know they made about $1.3 billion of revenue, and they're guiding for growth rate under 30%. So I'm going to assume about 25% growth for the next 4 years on an average. This seems like an optimistic growth rate for me because the revenue growth is slowing down significantly and there is a lot of competition in the buy now pay later segment. So if I assume this 25% growth rate for the next 4 years, in 2026, Affirm will make about $3.2 billion of revenue. Affirm has a gross margin of about 50%, and by the time it gets to the net profit margin, it would be about 15 to 20% when I compare to the similar companies with similar gross margins. So I'm going to assume a 20% net profit margin. This company would make about $650 million of net income in 2026. And with respect to multiple, for a 25% growth rate and 20% net profit margin, I can assign 22.5 multiple. But I'm going to assign 25 multiple for Affirm, and it's going to be worth about $16 billion in 2026. So when I looked into the number of shares, number of outstanding shares, this company had about 288 million last fiscal year, and this fiscal year they're saying the outstanding share count would be about 298 million. So they are going to dilute the shareholders by about 10 million shares. So I'm going to assume about 1% dilution in the next 4 years. So that would be about 310 million outstanding shares in 2026. When I divide the market cap of $16 billion with the number of outstanding shares in 2026 of 310 million, the stock price in 2026 would be about $52. Currently they're at 26, right? So that's about 2x. But like I said, there is execution risk with this company. We do not know if they're going to grow at 25% or more, and we do not know whether they will get to profitability of about 20% net profit margin. Because when I look at companies like Palantir or Snowflake, which are software as a service companies, their gross margins are in the order of 80%. So I would not be worried about their ability to make a net profit margin. When the gross margins are in the order of 50%, I get a little nervous because there's not a lot of room for operating expenses in this case. If they significantly decelerate their revenue growth in the coming years, the multiple is going to suffer significantly. So a 2x reward is not worth the risk for me at this case. So I'm still going to stay away from Affirm. But for the Affirm bulls out there, like if you really believe in this company and the buy now pay later theme, it doesn't hurt to take a small position if it goes below $20. And since this company is still in the growth phase, there will be a lot of volatility. So I think we would get a chance to buy this stock under $20, but I do not have the stomach for the volatility that this company offers. I have much better investments that can give me a 2x return with much lower risk. And my motto, as you know, is I rather have lower reward with lower risk than high reward and high risk. So for all these reasons, I'm going to stay away from Affirm stock.